Well, good evening, everybody. It's Richard Bowser here from Property Investor News, and this is the October webinar. So thanks for coming on board, everyone. Yeah, so we're into the we're into our October webinar. We'll be doing another one in a couple of weeks' time, but let's just go through what we're covering tonight, everyone. So I'm going to do a very brief market summary for you shortly, and then we will be handing over to our sponsor for tonight, which is Karl Griggs of CPC Finance, and Karl will be giving us a mortgage and finance market update. And then we're going to hand over to our main speaker for tonight, it's Manish Kataria, and he's with Invest Like a Pro. Obviously, some of you who are regular readers of Property Investor News will know that Manish is a regular contributor to Property Investor News, talking about a whole variety of subjects really related to financial and investment matters, and he's obviously a professional financial advisor. So let's get on with this presentation. And Life Beyond Lockdown is the title. And yeah, so it's just a quick market summary. For those of you who are not aware of Property Investor News, and we do have some guests on board tonight, we've been publishing this monthly magazine now for over 18 years, and it offers in-depth market analysis. It's not a get-rich-quick magazine. If you're looking for your next £1 million in the next few months, then perhaps it's not a magazine for you. But if you are interested in on an ongoing basis getting in-depth market analysis, then perhaps you might consider subscribing to Property Investor News. Because we've been going now for getting on for 19 years, we've got well over 15,000 articles now embedded in our website, and you can search those at your leisure. We've now got well over 250 searchable video interviews with developers, with portfolio landlords, and with trade sources talking about the marketplace. And this year we've done a lot of webinars. I think this is the 15th or 16th webinar we've done since March, the whole range of topics that we've covered. This is the second one with Manish. The last one that we did with Manish was back, I think, in March. That is like all the others that we've done. It's all these webinars are all recorded and saved in the Property Investor News archive, and subscribers can access all of those webinars and the videos and of course all the articles via your subscription password. What do we cover? Well, we cover land development, planning, HMOs, the whole range of topics that you guys want to know about. And when we do investor interviews, there's no fluff. I mean, the one we've just recently done in the October magazine with Claire Norwood, it's one of the most frank and honest interviews that I've done with a property developer. And her and her business partners, they really gave me some great information. I know that many of you on this call tonight, on this webinar, will have read that article. Really appreciate the honesty and the transparency that I got from Claire and Joe and Dan in that interview, talking about the challenges of property development in the current marketplace. So yeah, we've got more upcoming, but some really good interviews upcoming in the next few months. That's the website. Go and have a look at it. Okay, so let's just quickly just talk about where the market is at currently. And sorry about that. So this is Home Track. As some of you who watched previous webinars with me, you'll know that Home Track is one of my favoured sources of information to get residential property market analysis. So this was the picture at the end of August, so not that long ago. I think the latest Home Track data will be out in the next week or so, but this was the end of August data. What does it show us? Well, obviously, as we know, the market was very strong once lockdown occurred from June, July into August, into September. And I'm going to point out a little bit more data to you in a minute, but this was the regional picture. So on the left-hand side, you've got the top 20 cities by population size. We've got the average property value as of today, or as of at the end of August. Those are the average values. So in Aberdeen, 144,600 was the average value. And then we've got the performance over various periods, and on the far right we have the bar chart showing monthly performance from left to right over the previous 12 months. So the figures on the right are the most recent month's performance. So you'll see a whole mix of locations showing different performance. Some of this may not come as any great surprise to you, but clearly Aberdeen not performing well at all for quite some time. A location like Oxford, for example, where my main home is, out in Oxfordshire, a bit of a tick up there from Oxford, started the year quite poorly, and then demand has picked up, still not particularly strong, as you can see from the data. But of course, Oxford, along with Cambridge, London and Bristol, being one of the strongest performers over recent years in terms of average house value increases. And if you look at the second column, you'll see that Oxford had seen a 45% increase in prices since the middle of 2007. That was the previous peak, and 73% from the trough in 2009. In terms of the regionality, you can see there that the Midlands areas and the North Midlands and up into South Yorkshire, Sheffield, very strong performance. Leeds again, the Northwest, which is forecast to be the strongest region going forward over the next 3, 4, 5 years. That place like Manchester obviously showing strong performance. So that's the home track data, and this is very recent data. We only got in on Friday of last week, and it comes from home. And this is, I always find this interesting to show the trends in terms of time on market. So effectively, these are the strongest, the hottest locations in the country, including Scotland and Wales. These are the strongest markets. So if you're a property developer, these are the markets where you would want to be selling stock. At the moment, Glasgow and Edinburgh, which is number 8. So from left to right, these are the top 20 locations. So we can see that Glasgow, the strongest market at the moment in terms of time on market. That's the amount of time that a property sits in a virtual estate agent's window. So a real mix there. But what is interesting, of course, those that have been mentioning about the London market that's not being too well, you're going to see some real contrast in these figures here. Because Walthamstow in East London is number 4, and we've got Clapham in there as well, and Balham down in South London. So all this talk about the London market being in free fall, or has been, you know, it's very much, you know, you've got to look at the detail, and it's you know, it's not a one size fits all. There are 32 boroughs in London, including the city. So I think it is. So there we are. And then, so you know, we've got a real range here. We've got Bristol, we've got Coventry in the Midlands, been quite a strong market for a while now. We've got York, again a strong market, a lot of equity in some of those locations. Bristol still in there. So these are the locations where the market is the strongest and where you would want to be selling property. Of course, you would not want to be selling property in the worst performing markets unless you'd bought very, very cheaply. Aberdeen sadly continues to be the laggard in terms of the national picture. It takes now almost 400 days typically to shift a property there. But look at the contrast with central London, Mayfair and Knightsbridge now almost 400 days to sell a property on average. Many of these locations, as you can see, in terms of the worst performing markets, are in and around central London. And then we've got a few others in there, South Shields up in the northeast, but virtually all of them, in fact, North and South Shields to the worst performing markets. So there we are. That's the national picture in terms of time on market, and I hope you find that interesting. So I'm now going to, so that's me, take some notes if you're not aware of who I am, Richard Balzers. Now I'm now going to hand over to Karl Griggs of CPC Finance, who are tonight's sponsors.
Thank you, Richard. Hi, I'm Karl Griggs, CPC Finance. There's details on there and can be obtained on the website, etc. So what I'll do is just move on slightly to the next slide. which just gives you an outline of what we do. We do the whole of market, cater for all types of finance on property, development, first charge, investment, residential, commercial, HMOs, everything that most investors want. At the moment, we're seeing a very active market with a lot of properties being sold at the auctions. I think Richard mentioned to me earlier, auctions are, even today, we're selling at 80%, and a number of large auctions over the next few days to the end of the month, with many large number of auction lots. So be interesting to see the results of those in the next couple of days. So what I thought I would do was give an example of a current sort of topic, the way I've worded it, with the north-south divide, of how we can structure or help to structure different types of property to bring it all together to achieve a mix of high rents and using the equity of some existing portfolio. Going back to what Richard said in his earlier slides as well, which is if you've got properties currently in London where they're on investment basis, the rents aren't really achieving the levels that people want. So another way of using that is using the equity out of it, but keeping the properties. Particularly if you've got to, like the figures suggested, wait 300-400 days to sell an asset. Now, so the idea is that if you've got property in South, you've got a high value property, probably a low rent in relation to reaching the maximum loan to value that you want to achieve on a buy-to-let basis. Whereas up north, you've got a lower value property with a higher rent in relation to percentages. Now, what people are looking at is, in an ideal world, you want a high appreciation of the property over time, but at the same time getting a good return for your investment. So the perfect solution would be obviously a high value, high rent, and combining the two, so that you get the value of the asset over a period of time and the good rent going along. Now, the way that we've been able to help some clients and assist with that is an example of what I'm going to show you now. If we move to the next slide, got one of our clients, investors, had within his portfolio had 2 properties in London valued. One was 460, one was 450, producing a combined rent of 33,300 a year. Already had mortgages on them, so he had about £400,000 worth of equity within the 2 properties. He came to us because they wanted to buy a small in value but large in number of properties, i.e. 12 properties in Burnley, bought as a portfolio for 580,000, producing £55,500 a year rent. So again, this is a prime example where you've got an asset in London that is geared the maximum that it would on a mortgage basis, and then up north, low values but really good income, but that's not going to appreciate over a period of time. So what we were able to do was do one mortgage across the 2 properties in London and the properties being purchased, so that we could combine the equity of the south with the rental from the north, and give a mix within his portfolio. So between them, they had properties in the south and properties in the north, so you've got your hands in both pots really, so that you can benefit of both facilities. So if you can move to the next slide, please, Richard. So we ended up with total assets of just under £500,000, combined rent just under 90,000, which we were able to then get him a new mortgage of just short of 1.1 million, which by doing the one mortgage across the whole assets, repaid the existing mortgages, bought the new properties with no cash deposit put in by the client, and therefore it was great for him. He didn't have to as I say, put anything into the deal, and used the benefit of keeping the properties within London as well for the appreciation. He couldn't have done the deal if he had to sell the properties, because at the moment he probably wouldn't have been able to sell them in time to meet the purchase price, date on the contract that he had. So it's a way of structuring within the portfolio and taking the benefit of the equity without having to incur the sale. One of the other advantages of this is that the properties already in the portfolio were in the personal name. The assets being bought were in the limited company name, but we were still able to do a combined mortgage across the two. So it's one mortgage again against all 14 properties. So it came up with a solution for the clients without having to put in any cash deposits. There's numerous different ways that deals can be structured at the moment, and that's just an example of one. And again, it can work the other way with using the income of the north to help support a loan down in the south if you want to mix up the portfolio that you already got or want to expand into different areas. Whereas what most people tend to do at the moment is either stick to the south or stick to the north, but it might be worth considering a mix of the two for the advantage of both the income and the appreciation. So if we go to the next slide, please, Richard. If there's that's my details. If there's anything you ever want to discuss or fire over to me, happy to discuss and go through anything. And that's a brief summary of us. So I hand back to Richard, see if there's any questions.
Yeah, thanks. Thank you, Karl. That's great. Yeah, let's just have a look at the question box. Sorry about the flickering of the slides.
That's it.
Yeah. Let's just go to the question box. Okay. Okay. So, what is this type of mortgage called? Is a question from David Freen to you, Karl.
Right. It's a commercial investment mortgage. It's slightly dearer in rates than a conventional buy-to-let investment mortgage, because there is obviously a number of different properties involved. So it won't be your high street vanilla product. It'll be just slightly higher on rates than that, but it's a commercial investment mortgage.
Okay, great. And Richard Spong, you're asking me a question and you're not answering. So if you're going to ask a question, ask the question. So I know Richard from years back. Let's go on to Chris Bland's. What's the pricing on this one?
It's going to be the pricing. The overall pricing on that one is about 4.25%.
Okay, 4.25%. Yeah. Okay, this is from Nazim. Good evening, everybody. By the way, so Nazim is asking what kind of interest rate. Okay, so you've answered that one. I think you said 4.25%, 4.5%.
4.25%, yeah. Because we've got to bear in mind is also the actual individual values of the assets in Burnley is below most lenders as well. Because that's equates to about £40,000 a property. So it was a combination of everything that we were able to come up with the commercial investment mortgage in the end. Right.
What were the arrangement fees? Is a question from Nazim also.
The arrangement fee was 1.25%.
Okay. That's answered your question then, Nazim. Okay, question from Fahad Malik. If the landlord was to default on the payments, would the lender repossess the whole portfolio?
Yes, well, yeah, because it's secured on the whole lot. So, yeah. But the idea is that there's enough income within the portfolio that if one of the properties is empty, the affordability would still be there, rather than it being a single let property. If the tenant's not or the landlord's not paying, there is no income.
Yeah. With that whole range of diversity, north south.
Yeah, it'd be standard as any mortgage. If it's not repaid, then they take possession of the asset that it's secured on.
Yeah, and that's the reality, Farhad. Sorry. Okay, David Freen saying, is this 2 or 5 year money?
Within that, because of the affordability, you have a choice. There's a 3, a 5, or a 10 year product.
Okay, so up to 10 years there, David, for you to consider if that type of product fits what you're looking for. Nazim said, thank you very much for your response there. Chris Rose is asking, good evening, Chris. Would a mortgage such as this take into account the owner's income, or is it entirely based on the house's income? So top slicing is the term, isn't it?
No, it was purely based on the affordability of the 14 properties. They will look to make sure that the person they're lending to, particularly something like that, has got, which they have obviously, experience. They've got properties already in the portfolio, not first-time landlords. It's the overall picture of a commercial investment is that they've got the experience, got the know-how, and an outside income. There isn't a minimum income, but as long as the credit isn't stretched, there isn't normally a problem.
Okay, that's answered your question there, Chris. Okay, so Richard's now come. This is Richard's point. Come back to me. Just one question. You say the scheme is based on high yield in North and appreciation in London, but appreciation in London cannot be guaranteed now.
No,
can it?
No, definitely can't be guaranteed. But the history says that the properties in the south have made more money over the years than the ones in the north. But the income in the north is a better return than the income in the south. It's just based on historic figures.
I'm not going to disagree with you at all, and I can speak from my own portfolio as evidence of that, because I'm someone who has rental properties on good yields up in the north and properties down in and around London. And I said this on a webinar quite recently, that yeah, there's question marks over London, maybe over the next 3 to 4 years. Perhaps because of COVID, perhaps because of Brexit, perhaps because of affordability. But I think over 7 to 10 years or more, you would not, you'd be going against history if you bet against London, would be my call, Karl. Yeah,
look, regarding the term the South, it's not just central London. No. You've got outer London, you've got the home counties where the figures are mirrored as well. Out as far as Watford, into Essex, Kent. It's the term South just isn't central London based on your 2 slides earlier. There's hot that are making money and there's areas that aren't, or not selling as quick. And that you've got to pick the right area within the South.
Yeah, as I said, I think going back to those slides, Balham, Clapham, very different performance currently from some of the central London, prime London, zone 1 areas that are clearly not doing so well in terms of current demand. Okay, let's get a few more questions in before we. Nazim's come back with it saying, how long would the loan term be? I think you've already answered that one.
Yeah, well, we can do up to a 20-year interest-only facility with fixed rate options of 3, 5, or 10 years. Okay, so yeah, I hope that's answered your question, Nazim. Okay, so Sajid Shah, good evening, Sajid. He's saying, could this apply to a furnished holiday let deal? No, these are just residential buy-to-let products.
Yeah, that's a specialist area, isn't it, Karl?
Yeah.
Do you have lenders that do furnished holiday lets?
We do, yeah. Again, at the moment, the problem is that the recent history is there's no what income they rely on, what income the valuers are going to rely on, and how long until it's back to normal. Yeah,
because obviously service accommodation, that whole sector was hit very badly, and obviously some of them had a very good summer. But it's certainly, as we've seen most recently with some of these lockdowns, it's a real mixed picture. So obviously you can get in touch with Karl Sajid if you're interested in that. He can obviously maybe help you out a little bit more. Chris Rose says, thanks for that response. Chris Bland is saying, is there a personal guarantee required?
Yes, there is. Well, if it's in the limited company, yes. It's restricted to 25% of the advance.
Okay, that's crystal clear. Nazim Khan is saying, how do you manage the limited company and personal mortgage offer?
Because the personal the properties in the personal name are the same as the shareholders of the limited company, they were happy to do a cross charge across the lot.
Okay, hope that's clarified that for you, Nazim. David's coming back with saying, fees, please elaborate, if possible.
In respect of?
Yeah, I don't know. David, do you want to just, we've got 2 more minutes.
Done the arrangement fee of 1.25%. Obviously, there's valuation and legal fees.
Okay, that's clear. So guys, in terms of the nitty gritty, if you can get in touch with contact details for Karl, they're there. Nazim's saying, is it separated on the mortgage? I assume he's referring back to the limited company and personal guarantee.
No, it's one mortgage across all the assets. If you wanted to sell one of the properties off, you'd part redeem it down on a loan to value pro rata basis, but it's one loan advance secured on the 14 properties.
Okay, interesting. 12. So David's saying 12 valuation fees, 1 legal fee? Question mark.
It's one legal fee. Yep. The valuations, there was 3 separate valuations. The two separate buy-to-lets in the south, and 1 separate one for the whole portfolio up north.
Okay, so 3 fees, right? I'm going to have to close off these questions because we've got managed waiting as well. Let me just right. So Nazim saying, if your loan to value across the portfolio is lower than the example provided, could one get a better interest rate?
There are other rates available based on the loan to values. Yeah.
Okay. Okay, Nazim. Richard, we're going to have to run that one afterwards. Are there any early redemption penalties? That's from
yes,
Richard.
there are. There's it's normally 3%, depending on what fixed period you take.
Okay, everyone's saying thank you. One from Anil Patel, and I'm going to make this the last question. Would the lender lend jointly to a company and SIP for financing commercial property purchase?
That particular lender doesn't do the SIP side, no, but that doesn't say that others won't.
Okay, so some real detail there. I hope you've got some value from those responses from Karl, but of course he is available for you to contact, email, telephone, CPC Karl Griggs. There's the details, and they're a regular advertiser in Property Investor News, and of course they are the sponsor of tonight's webinar. So Karl, thank you as always for that presentation, and by the looks of it, quite a bit of interest in that product. So you've heard about it. It's up to you guys to get over and speak to Karl and CPC and the team and find out more details from Karl. Right,
excellent.
Karl.
Thanks very much, Richard.
Thank you.